What happens after a company buys a long-lived asset? In this video, I explain changes to depreciation estimates, introduce the basics of non-straight line depreciation, and talk about how companies decide whether to capitalize or expense continuing spending on an asset. In the prior video, I introduced the straight line methodology for depreciating long-lived tangible assets. And it makes sense to focus on this methodology because 92% of US public companies use the straight line methodologies for either all or majority of their asset base. However, we do have several alternative methodologies, so it makes sense for us to introduce them just to be aware of what they are and when we might see them. First of all, about 4% of companies have some of their assets on an accelerated depreciation methodology. Under accelerated depreciation methodology, the company will recognize higher depreciation expense in their earlier years of the asset and lower depreciation expense in the later years of the asset. So unlike the straight line where the depreciation expense is literally equal in the first and last year that you were using the asset, this one is going to be accelerated. Now, why might company do that? Very important here. A lot of people say, well, they do that to save on taxes. Absolutely not. Keep in mind that what I am covering in this channel is just the GAAP assumptions, so the generally accepted accounting principles, so the decisions that we make for financial reporting purposes. That doesn't match to the decisions that companies must make for the purposes of preparing their tax return. As it happens, for the preparation of taxes, the long-lived asset depreciation is in fact done on an accelerated basis, but that doesn't actually match to what the companies do on the financial reporting purposes. It is very common for the majority of the firms, they will have the straight line methodology for an asset for financial reporting purposes, and then they will have the accelerated, which is the methodology that's prescribed by the tax code for the tax purposes. So just keep that in mind that when we're talking about estimates and managerial decisions and discretion and the appropriate applicability of accounting standards here, on this channel, we are focusing on the financial reporting unless explicitly we get into some tax discussion that I will specify. Let's look at a couple of examples of firms that do disclose in their financial statements that they use the accelerated depreciation methodology. The first one, Northern Corporation, has a very nondescript disclosure. It doesn't actually tell us why they use the accelerated methodology. It just says that depreciation is computed using the accelerated method over the estimated useful life of the asset. They don't provide additional information, so we don't really know why it makes sense for this particular company. In contrast, we have disclosure here that provides a lot more detail. This is from Heartland Express, and they talk about a specific type of asset. So this is for their tractors. For financial reporting purposes, they use something called the declining balance method. It's one specific type of accelerated methodology. They do go into discussion why they think that this methodology is appropriate for them. We believe that this method more accurately reflects actual asset values and affords us the flexibility to sell tractors at most points during their life cycles without experiencing losses. This is something that I am going to tackle in the next videos. I will talk about the gains and losses that you might recognize when you sell an asset, maybe before it reached the end of its useful life, or even if it did reach the end of the useful life. And what they're saying is actually true, especially if you're selling an asset before you got to the end. It is very reasonable that if you're doing a straight line methodology, then the book value of the asset, which is the cost minus accumulated depreciation, is probably higher than the market value at that point in time, and you would recognize a loss on the sale of the asset. So it seems like for them, it's important to have this flexibility that they don't always have the tractors all the way until the end of the estimated useful life. They want to minimize any losses that they might have on the sale decision, so they choose the accelerated methodology. They also highlight that the decline in depreciation during later periods is typically offset by increased repairs and maintenance expense as the tractors age, which is also an interesting point. It is absolutely true that older assets typically require higher repairs and maintenance. So if you are offsetting the repairs and maintenance with lower depreciation, your overall expense level is going to be more stable over time. Let's talk about repairs and maintenance a little bit more. In the prior video, I introduced the capitalization versus expense decision, and I talked about the fact that for tangible assets, the question of whether it provides clear benefits in the future is kind of a non-issue. When you buy tangible assets, usually the answer is very clear, yes, and you will capitalize it. But importantly, for the same tangible assets, it is very often that you continue to spend money of them as you have them. And now we get into a more interesting discretionary question. The manager needs to determine whether the cost that they are incurring is an improvement to the asset or whether it falls into the category of a standard repairs and maintenance. They're going to be treated differently from the accounting perspective. If you decide that you are doing an improvement to the asset, this might be called capital expenditure, capital addition, capital improvement. That means that you're really building the asset to a base that's higher than what it was previously when you bought it. You are increasing future benefits, and that could include increasing capacity, efficiency, quality, safety. Somehow you're making the asset better, and that allows you to capitalize any cost that you are incurring to improve this asset. You would add it to an asset account so you don't expense it immediately, but of course, it does lead to higher expenses in the future because now the total cost is bigger. So the amount that you will allocate to the income statement via depreciation will also be larger. In contrast, if you say the money that you're spending on this asset is just to keep it functional, without spending this money, the asset will start to perform at a level that's below where you intended to be. Then you consider this a standard repairs and maintenance expense. You don't get to capitalize it. Why? Because you're not improving something for the future. You're just keeping the asset functional in this period. So we think of it as only benefiting the current period. Think of oil changes and tire rotations. These are the things that you have to do continuously. So it makes sense that when you incur them, you just expense them immediately in the period where they occur. You can probably see that this requirement to classify a continuing spending on an asset as either a capital improvement or repairs and maintenance requires judgment from the management because there's so many expenditures on the various types of assets that routinely go as part of the operations of a company. To illustrate that this is discretion, I'm going to show you a couple of SEC comment letters. The SEC is the Securities and Exchange Commission. This is the main regulator of financial reporting in the United States. And one of their jobs is to review the financial filings of the companies and to reach out with questions if they have concerns about the appropriate treatment of certain transactions. Here we have the SEC reaching out to BNSF, and they're talking about specific activities, rail grinding, shoulder ballast cleaning, and they say, please tell us whether you capitalize the cost of these activities that we think of as repairs and maintenance. The SEC is pointing out that these activities, they think of them as kind of happening at recurring intervals. The SEC does not view this as extending the life of the asset beyond the current estimate, and it doesn't view it as enhancing the original state of the asset. Rather, this is just kind of keeping it operational. So the SEC believes that expensing as incurred is the preferable method of accounting. As another example, this is a Terra company, and the SEC is again saying it appears that the primary reasons you undertake planned turnarounds is to maintain production. Maintaining production units instead of improving them or kind of fundamentally changing them is not something that you should be capitalizing. More appropriate would be the expense of that. Now, in addition to the accelerated depreciation methodology, another method that you might see is something called activity-based or units of production methodology. The way that it's typically done is instead of dividing our depreciable cost by expected useful life in terms of the years of the asset usage, we're going to divide it by actual output that we expect to get from this asset. So for a car, it could be miles driven. For a particular machine, it could be parts that it produces, something like that. And then what the company is going to do is actively keep track of that output measure. So every quarter, they would say how many miles were driven, and they would reflect the depreciation expense, the allocation of the cost from being an asset to being an expense based on the actual usage of the asset. So it could be high in some years, it could be low in some years, depending on how the asset is actually being used. This methodology certainly requires more accurate record keeping, which could be just a document document-heavy process. However, it is going to be more precise in terms of matching the depreciation expense to the actual usage of the asset. We particularly see this commonly in the natural resource industries, so oil, coal, timber. There, we don't typically call it depreciation. We call these natural resource assets as being depleted. So what we have here is the depletion expense that matches to the actual usage of those particular assets. Now, one difference in terms of what happens to these depletion expenses, they are not immediately hitting the income statement. Instead, as we calculate the depletion of these assets, these get converted into the inventory asset on the balance sheet. When do they hit the income statement? When the inventory is actually sold through the normal process of cost of goods sold that I've introduced in the prior videos. Let's take a look at how long-lived assets and depreciation are typically disclosed in the 10K. If we go into the footnotes, we often find a fair amount of granularity in terms of what type of assets are included in the overall category PP&E or fixed assets. And it's really going to depend on what is normal for the industry and kind of the specifics of how the company does its business. For example, Johnson & Johnson is a manufacturer. We see that among the assets, they have land and land improvements. The difference between land improvements and land is a indefinite life useful asset. Land improvements are the things that you have done to the land that you expect to need to redo. So for example, let's say that you bought a piece of land and you paved it to create a parking lot. The underlying land itself would go into the category land and you don't need to depreciate because it never stops being useful to you. However, the paving of the parking lot is something that you expect to have to redo maybe every 10 or 20 years. So that would be a land improvement asset. We also, for Johnson & Johnson, have a lot of fixed assets in the equipment, fixtures, and furniture category and a fair amount in construction in progress. In contrast, Accenture, a consulting firm, is just a lot less fixed asset intensive overall. And specifically, they don't have separately segregated land or buildings. They do have leasehold improvements. So leasehold improvement is a category that reflects that you are renting a space, but you have done something to it. So you did specific fixtures which are unique and necessary for you in order to occupy the space. And those are depreciated typically over the term of the lease. And then we have equipment, fixtures, and furniture, and they actually have a lot in computers, software, etc. Does that mean that Johnson & Johnson doesn't have computers because there's nothing here in the computers category? No, that just means that they include computers in equipment and fixtures. Best Buy looks very typical for a retail company. They have some buildings and land, but not a whole lot because Best Buy, like typical retailer, actually rents a lot of their spaces. That also leads them to have a sizable leasehold improvement and certainly some equipment, fixtures, computers, etc. Home Depot has taken a somewhat unusual for retailer approach that instead of renting majority of their storefront space, they actually own the land underneath and the buildings themselves. So they have a large amount of fixed assets that fall into these categories, as well as assets in the other categories. This is the detail that typically we do not see on the face of the balance sheet, but we can find in the footnotes in the 10K discussion related to long-lived asset. And on the balance sheet, typically what we see is either just the total amount, the gross property, plant, and equipment offset by accumulated depreciation, or a lot of companies don't even give us on the face of the balance sheet the gross PP&E and the contra asset accumulated depreciation. They just give us the net PP&E number. But again, in the footnotes, we're always going to be able to find this information. So that's in terms of the asset and the contra asset disclosure on the balance sheet. Where do we find the depreciation expense on the income statement? There is a fair amount of variance in terms of the presentation of the depreciation expense on the income statement. Here are a couple of examples. One is really an unusually clear disclosure. This is from a mid-sized company called Molly Corp. And what we see is on their income statement, we have the revenues, and then we have the cost of sales, which is another way to call cost of goods sold or cost of products. And they break out the cost of sales into the cost excluding depreciation and amortization, and the depreciation and amortization that belongs in this category as well. Further down on the income statement within operating expenses, they have the selling, general, and administrative expenses overall, but also they have the depreciation, amortization, and accretion that relates to the operating assets. A much more typical disclosure, something we see from Alphabet. If you go in the income statement, there is nothing that sounds like depreciation. Does that mean that they don't have depreciation? Of course they do. If they have long-lived assets with finite useful life, then they do have depreciation. And in fact, on the statement of cash flows, we can see the total amount of the depreciation. And in the footnotes, they provide to us information that suggests that depreciation is included in not just one or two, but in three different categories on the income statement. The depreciation that relates to items such as servers and network equipment is included in the cost of revenues, which is the Alphabet's version of cost of goods sold or cost of sales. Depreciation for general assets like office space is included in general and administrative expenses, and depreciation for R&D related assets is actually included in the R&D expense. And they don't give us a breakdown in terms of how much depreciation is in each of these categories. Again, it is actually pretty common not to see depreciation as a separate line item on the income statement. But if you do want depreciation because, for example, you're calculating a subtotal such as EBITDA, earnings before interest, taxes, depreciation, and amortization, you can always find it on the statement of cash flows. When you watch the statement of cash flows video, particularly the cash from operations using the indirect methodology, you will understand why depreciation needs to be separately disclosed on the statement of cash flows. When you're buying the asset, you are asked to come up with an estimate, often looking a significant amount of period in the future. You're asked to think about what is going to be the useful life of this asset to you, what is going to be the residual value of this asset when you're done with it, and potentially you're thinking ahead to something that is 2, 5, 10, or 20 years down the road. So it is fairly normal to have depreciation estimates that turn out not to be exactly accurate. Maybe it's going to age faster, maybe it's going to be useful for longer, or maybe the residual value is going to be different. Again, this is quite normal if you have a change in the depreciation estimates, as long as the original estimates were done in good faith. We don't need to go back and change the expenses that were already recognized. All of the changes to the depreciation assumptions are going to be prospective, meaning when the management determines that the assumptions must be changed, they're going to recalculate depreciation expense and change it going forward from that point in time. By the way, this is very commonly triggered when there is a capitalized addition. So when you are spending some money on the asset and it is not the standard repairs and maintenance, but it is rather a fundamental improvement to the asset, then of course what you're doing is changing the overall cost of the asset. So that mechanically necessitates the recalculation of the depreciation expense going forward. But there could be other situations, and that's why it's important to have the communication between the operations and the accounting department in terms of kind of triggering signals that the use of assets is different than anticipated, and maybe some of the assumptions that were in play are no longer valid and need to be reconsidered. So let's take a look at what exactly happens if you need to recalculate your depreciation expense going forward because of the change. You will calculate the new remaining depreciable cost. You will start with the old cost. How much did you buy this asset for? How much did you spend to prepare it, to ready it for usage? You will add any capitalized additions if we're talking about a situation where you are spending something on the asset that increases its capacity, useful life, etc. You will subtract any depreciation that you have already recognized, because any amount of original cost that you have already expensed doesn't need to be expensed again. It has already hit the income statement. So we're going to subtract that. And then you're going to subtract your new best estimate of residual value if it changed. If it didn't change, just subtract the old residual value. And whatever you calculate as depreciable cost will be divided by the remaining useful life at this point in time. And that will give you the depreciation going forward. Let's take a look at an example. On January 1st, 2025, a firm purchased equipment for $100,000. That's the original cost, the estimated 10-year useful life, and an estimated $10,000 residual value. So those were original assumptions. On July 1st in 2029, the firm carried out a capital improvement at a cost of $20,000 and changed the estimates to residual value of $12,500 and a total useful life of 11 years. So we have three changes going on here. The cost changes because we have a capital improvement. The residual value changes from 10,000 to 12,500, and the useful life changes from 10 years to 11 years. The straight line depreciation in the earlier years was the cost of 100,000 minus 10,000 residual value divided by 10 years. So that's 90,000 divided by 10, $9,000 per year. So during the period 2005, 6, 7, and 8, the company recognized annual depreciation of $9,000. And because they're making this capital addition in the middle of the year in 2029, they would also recognize half of that amount in 2029 as well. What is going to be the straight line depreciation after the capital addition? Let's start by thinking, what is the total cost of this asset, including both the original cost that we have incurred to get this asset ready for production and the capitalized addition? It's $100,000 plus $20,000 of the new capex. So the total cost is $120,000. How much of this $120,000 has already been recognized as an expense on the income statement? Well, we are now 4.5 years into the usage of this asset. If the depreciation expense was $9,000 per year, our accumulated depreciation, the contra asset account, is up to 4,500. That means that the book value or the net PP&E after the CapEx is the original cost, 120 minus how much we have already depreciated. It's $79,500. Now, we don't need to depreciate all of this amount because we do expect to get something at the end of the useful life of the asset. The new residual value is $12,500, and we see that our new remaining depreciable cost is $67,000. And the final step is we're going to spread this over the estimated useful life that's remaining to us. So we have updated the total useful life of this asset to 11 years, but we are already 4.5 years in, so we only have 6.5 years remaining. So if we spread $67,000 over 6.5 years remaining, we will have depreciation of $10,308 per year. In this example, our depreciation after the capitalized addition is higher than the depreciation before, but I want to highlight that the change in estimates could go in both directions. Depending if our original estimates were too aggressive or too conservative, we could have a recalculated depreciation which is higher than the original estimate or that's lower than the original estimate. Here's a couple of examples from real firms that bring to attention the fact that their depreciation estimates have changed, and that's why we see a depreciation number that's different than what was observed previously. For Alphabet in 2013, they're saying we revised the estimated useful life of certain types of property and equipment, which resulted in additional depreciation expense of $207 million. In contrast, for Crown Packaging, we have disclosure from 2024 that highlights that the company completed review of useful lives, and the change resulted in net reduction of depreciation of $64 million. That tells us that they have revised their estimate to longer useful life. Now they're spreading the cost over more periods in the future, and that leads to a recalculation of depreciation and a lower expense than we saw previously for this company. What happens if you have fully depreciated an asset? You go along, you get to the end of the expected useful life, but the asset is still usable to you. Is that possible? Yes. So first of all, you won't record any additional depreciation unless you're going to change the residual value at this point and say, oh, because I'm using it a little bit more, the residual value, it's actually going to be a little bit lower. But assuming that you're not making any additional change to the assumptions, you have just fully depreciated the asset. You have recognized all the expense that is appropriate to recognize for this asset. So you're simply not going to recognize additional depreciation expense. Can you still use the asset? Well, that's really an operational question. So if the asset is still usable, then you're just going to keep both the parent and the child account as they are. So the gross asset and the accumulated depreciation will just stay at the same level as you continue to use the asset, and you just chalk it up to the fact that foresight is not perfect and your estimates are a little bit off. For example, Home Depot says The decrease in depreciation amortization, this is from 2011, reflects an increase in fully depreciated assets. So they are saying we were a little bit too conservative in our estimates. It turns out we're able to use these assets for longer than anticipated. They're now fully depreciated. We have no other expense to record on them. So we're just going to keep using them. The only question that I would have when I see a disclosure like that is this a situation where the company would prefer to have newer assets, but they're not able to replenish their asset base because there's some liquidity concern, cash flow concern? So from this disclosure, we can certainly take a look at other disclosures in the 10K and see if there's any red flags that suggest that the company is not able to get access to a new asset base. But if that's not the case, again, we just chalk it up to the fact that these estimates are really hard. We're asking management to think many years into the future, and sometimes they're going to be a little bit misaligned, and we find ourselves in a position where we have fully depreciated assets, which still have a little bit of life left in them. Thank you for joining me for another long-lived asset video and for diving into some questions relating to repairs and maintenance versus capital improvements, estimate changes, and using fully depreciated assets. I hope that you enjoy the video. More are coming, including one on the gain and loss on the sale of long-lived assets, as well as on intangible assets. So I hope that you join me for those. If you like the video, then please like, subscribe, tell your colleagues and friends, and I'll see you in the next one.